Awesome. Are you in New York?
No, I'm still here in Southern California.
Welcome.
Next
Glad
week
to
in
have
New
you.
York.
We're in San Diego today at Buchalter. They were kind enough to host us today. As you know, we're doing commercial real estate. So you being a family office is so important to us. So thank you very much for being a part of this. On my far left is Stephen Shipp. He's with Performance Advisory Group. He's going to be able to give us a lot of information on bankruptcy, proceedings, workouts, loans. And then to my right is Brian Atkins. He is a lawyer here in the real estate group here and in Seattle for Buchalter. He does a lot of work in the housing discrimination area as well as commercial multifamily. Gentlemen, welcome.
Thank you.
Nice to be welcome. You too. So let's get into this. There's a lot going on in commercial real estate. I think in the last, 5 years, because of COVID, we've had a dramatic change in the real estate market. We've had it in every type of multi-housing. We've had it in family housing. We've had it in Section 8. We've had it in warehousing, and where it's been the worst has been office. So we're going to talk a lot about that because we're seeing just structural changes, fissures throughout the entire real estate industry in the last 3 years. We're starting to see a lot of cash buyers come to the market for commercial real estate distressed debt. So I think, Stephen, you're going to be able to, talk about that.
Certainly.
A couple of the sort of big funds recently that have been buying all cash distressed debt have been RXR, Artemis. Artemis put together a $2.2 billion fund just to do that. SL Green did the exact same thing. They have dry powder of over $1 billion. Then we saw BlackRock do the same. And then we had a couple rescue capital funds put together by Noble Investment Group. They recently purchased 25 hotels and they did it for $1 billion. So real estate, if you're a good buyer and you can do your due diligence, it's on sale. So let's talk to Brian Atkins first. Brian, because you're the host and you're with obviously the firm, talk a little bit about multifamily. I mean, multifamily has had, a great resurgence in the last 3 years, right? Because, we really need multifamily, not only in Los Angeles, but in Texas and, Florida and the Northeast, if you look at all the smile states, right? So multifamily has really been the key. Talk a little bit about, from the family office perspective, why multifamily just continues to be the right investment for family offices.
Yeah, I mean, all the things you said, it's starting to recover after the COVID pandemic. The rental rates kind of just always, they stayed pretty consistently high during that time period, and now they're kind of continue to go upward. And there are a lot of opportunities out there right now where people have over leveraged and opportunities for a well heeled buyer to come in and find some opportunities for investment.
Absolutely. So if you're representing me and I'm the family office and I'm the second generation, are you finding that the second generation in family offices are just as good as the first generation, or they tend to be a little bit distancing themselves from the real estate and want to do other things? I want to be a doctor. I want to be a lawyer. I, want to go into the arts. Or do you find that the second generation from the original generation will move into dad's business?
Yeah, I've found that the second generation is kind of they're reticent to stay in multifamily, I think. For different reasons. They don't want to have to deal with the regulatory environment that we're seeing. We're seeing just increased legislation. I mean, even here in San Diego, which is traditionally conservative, it's becoming more liberal, more tenant friendly. So the regulatory environment's a little bit difficult to manage, I guess.
But if I'm a second generation, I want to go into the arts, you can't stop me, right? Because I might come back to you and say, okay, you're the executor of the estate, or the assets have been coming to me. I might liquidate at the wrong time. How do you counsel a family office to stay in the game?
And just kind of look historically, have them kind of look historically at the returns that multifamily brings, and just look, this is kind of a blip right now with the regulatory environment and how things are going. Historically, real estate just continues to go up, and I think, it will continue to do so. So,
right. And I'm in agreement with you because that's how I got to graduate school. It's how I got to law school. It's how, my lifestyle was really put together because of Gen 1, and now I'm in Gen 2, and I'm seeing that in Gen 3 with some of the families I work with. So, Rich, you're a family office, right? So with your family office, and I know your background pretty well, and I think what's interesting is in your area, you've got 7 partners, right? So if you've got 7 partners and you were established in 2011, and you focus on, buying and holding and long term, how do you work with the other 7 partners in your business to decide, okay, what type of commercial real estate should we go in, and who breaks all ties?
There is no try-baking. We have a unanimous consent approach. So that's the approach we learned over the years that works for us. We are 7 guys and a gal who we know each other for decades, and we transact on transaction basis. And our goal is to create either legacy capital or transact. So transaction is we are buying and selling, buying in, maybe enhancing some working environment of the property. Either it's a class B or C, or is multifamily, or is a warehouse, or is just a strip mall. We are indifferent to what product group it is, but we are very careful in investing capital only where there's economic viability. We're not investing capital for just to invest capital and wait for it. We are looking to maybe flip the property within 3 to 5 years.
So
And we've been very, very lucky with that.
Yep, give me a number on what you're going to put into the asset. Is it 5, 10, $15 million? Is that what the pool can hold? Is it more? And then what is your period for a full market cycle? Is it 5 years? Is it 7 years? Talk about
Well, the market cycle.
Not only the acquisition amount, the dollar amount, that 5, 6, $10 million, but talk about the disposition. How long is that? Is that 5 to 7 years out?
Well, we have no, it's not a hard and fast rule. We have flipped the property within 8 months, depends how we bought it. And we have some properties we had to stabilize, fix them, took 2, 3 years. Our tenure usually is between 3 to 5 years. It's not much greater than that. Our dollar size equity, we usually are in between 3 to 15, maybe 20 million. And then we can also get para passu equity from other partners or other family offices, and debt is plenty available.
Wow. Okay, so let me flip over to Stephen. Stephen, obviously, again, with your firm, is Performance Advisory Group. Recently, Josh Friedman, everybody knows who Josh Friedman is, co-founder of Canyon Partners up in Beverly Hills. He came out and he said that he'd be surprised to see if the Fed cuts rates before the 2024 election. And his reasoning was he just doesn't see a reason for the Fed to cut rates. Talk about your expertise in distressed real estate, troubled real estate looking for rescue capital. Are interest rates really going to affect your business in helping families, family offices restructure?
Yeah, well, certainly. Interest rates have been the primary cause of both a massive run-up in commercial real estate valuations, particularly in the multifamily space, and has been a primary contributing factor to the distress we're seeing. As I look out the window here, and our audience can't see it, I look at a ton of multifamily and office building. I would say 2/3 of the stress of this stuff that we're seeing is either in distress today or will be in distress. We've got $2.5 trillion worth of maturing commercial real estate debt over just the next 3 years. That number, by the way, is matched on the corporate debt side, $2.5 trillion in non-refinanceable debt today, which means this stuff will be distressed. So getting back to this issue of multifamily, vintage 20 through 2022, there was $100 billion in bridge debt used to finance new acquisitions of multifamily. 90% of that debt is either in default or will be in default in the next 16 months, which means there is an extraordinary opportunity. Family offices that are well positioned to take advantage of that.
So let me take another step with you. So PIMCO, last year, they walked away from 20 hotels. I just walked away from 20
That's right.
hotels with over $240 million of debt. Now, when that came across the wire, what was your first reaction?
It's a game that we see constantly. If you look at some of the biggest and brightest in the business, Brookfield is an example, Starwood's an example.
Yep.
They started giving their assets back. Prime Class A downtown office assets.
Yeah.
Downtown LA office portfolio held by Brookfield. They started giving that stuff back. When I say give it back, that's really misnomer. Lenders never really owned it, so you can't give the property back to the lender, but they gave up. They said, I can't recapitalize this. There is a massive credit crunch for office building refinancing in this world today. And so they just started giving back what eventually was, and again, I'm talking about Brookfield's downtown LA product, Class A, beautiful stuff. They started giving it back a year and a half ago. And by the end of this year, they'll probably give 100% back of the $1.3 billion portfolio they acquired in the mid 2000s.
Is there a contagion from this? Because, you know, there was an article a week ago or a couple of weeks ago about how all these Canadian pension funds are kind of selling back buildings that they bought for hundreds of millions for these single millions. You know,
That's right.
$150 million they bought, they're selling their interest back for $5 million, something like that.
Is there a contagion? Well, certainly there is. I mean, we know that the whole COVID issue caused sort of a work from home phenomenon. And that hasn't really reversed itself. As an example, if you look at San Francisco's average physical occupancy, it's 57% of where it was prior to the pandemic.
And where could Oakland possibly be?
It's just as bad, right? And that's sort of attributable to a variety of factors, but San Francisco as a city has been absolutely devastated by what's going on, both in terms of Federal Reserve policy and work from home, which to me brings a huge opportunity to create what I consider generational wealth. If you're able to buy an asset at 10 cents on the dollar from what it traded for in 2017, 2018, 2019, if you've got the holding power and you've got the ability to underwrite, that is something that is a generational opportunity.
So Sam Zell, everybody knows who Sam Zell is in the room. He died just a few years ago. And when I was working in New York for BlackRock, he built a fund called Grave Dancer, and he built it right at the absolute top of the worst real estate market that we ever saw. And he put together several $1 billion and sold it for multiples of $7 billion. So, you know, a guy like him comes together and puts together a product called Grave Dancer. And I think he actually had Grave Dancer 1, 2, and 3. We weren't an investor too bad, but there's somebody that gets it. So let's move over, you know, back to yourself here, Brian. You represent out of the San Diego office, you represent out of the Seattle office. What are you seeing sort of in that Gold Coast, Pacific Northwest? What's going on there with multifamily, since that tends to be an area you concentrate on?
Yeah, I mean, again, it's the regulatory environment. The city of Seattle has been very tenant friendly as of late, implementing a lot of new regulations that kind of make it more difficult to operate as a multifamily operator. And a lot of my clients, I mean, most of my clients are multifamily owners and or management companies. And they're just finding it so difficult. And they're trying to, I mean, the evictions, I mean, they're going for the roof. And in Seattle, I had a general counsel that I met with the National Apartment Association, and he said, like, we don't have anyone to handle these evictions. We don't have attorneys to handle these evictions. There are just so many evictions. It's a lot of it is because of the hurdles that the regulatory environment, the legislature has put in those different areas. So I hate to like just keep going after the regulatory.
But that's
environment,
okay.
but so
And I'm gonna come back to that because I'm seeing the stress throughout the entire industry. So
it's causing distress.
it's amazing. And then Rich, I'm gonna come to you. So Marty, go right ahead.
So getting back to this utilization number, you gave 57% for San Francisco office. Is that how many people go weekly basis or every day of the week?
It's average daily occupancy.
Okay,
Is what number?
nobody goes on Monday and Friday.
Yeah, it's the average occupancy.
Okay.
And this is not economic occupancy, this is physical occupancy. Some of these buildings could be 90% leased, yet that if only 50% of the occupants are actually attending. And that's one of the reasons why we're seeing leases not renew, or if they do renew, they renew at much smaller square footages, and in many cases, much lower pricing.
Yes, sir.
Is anybody doing office to residential conversion?
Brutal, absolutely brutal. I've got many clients that are doing it now. They're getting their teeth kicked in because if I take this office building and I want to convert it to residential, what's wrong? The bathrooms. The plumbing is fixed. The men's are over here, the women's are over here. How do I move that around? Second is modular. I've got multiple modular clients that are putting together modular apartments to stuff inside of an office building. They're having a terrible time. It can't be done. So that conversion that everybody thought, great, I'm just going to change the housing atmosphere, doesn't work. They can't get it to work. And if they do, it's not economical. Their net profits at the end of the day are just horrible. So it's really tough.
Reno, in effect.
I'm sorry, say it
You're talking
again?
about a full gut reno at that point.
Doesn't have to be. It doesn't have to be, but it's very difficult to do. So to answer your question, there's just not a lot of progress. I'm in touch with a lot of funds. They're not going to touch it because they just think it's really too difficult. So to your point, what's going to happen to all this office space? And again, they're going to have to just figure out how to make it work. So Rich, let me come back to you. So Rich, I know because, you're in that family office area and you're right now putting together projects in St. Kitts. You're, doing some work with the St. Regis Hotel. You're looking at about 110 different lots. Why have you decided to sort of leave the US, go to an island, which is just impossible to get, products and goods and services and get all your wood and steel and, hire an entire force? Why would you open up a hotel there and not do it here?
Remember, we are opportunistic investor. Whatever the opportunity is, we have this connection with this family for decades, and they approached us. So, and the numbers pencil out very, very well. The prime minister of those two islands are supportive of the project. They are much, much pro-business than I call it, than California is. I was going to use some C and M words, but I choose not to. But to add on to Brian and Steve's comment, there are about 50 banks which are on death watch. There are about $500 billion of losses in the banks, which hasn't come through. And multifamily apartments are always the biggest and the best investments. And now we're seeing the trouble is these damn rent control laws and observation thereof, or even suburbs in California where you are now can convert any suburb into a forced lot and convert them. I don't know what the policy impact would be on the long term, but in the short term, rent control is killing multifamily investments. And there's not too much appetite to go into any multifamily or restructure or try to come up with because of rent control. Expenses don't go away and you can't raise the rent. So what do you do with that?
I think Marty has a point he wants to put on that.
Rent control don't apply to ADUs, do they?
Right.
Oh, yeah.
Yeah.
Well, absolutely.
Yes.
Absolutely. If you build it, you bet rent control.
Yeah.
To Rich's point, I see a lot of like the more mom and pop or the smaller operators just getting out of the business. altogether.
Yeah.
It's just, it's too, the rent control that doesn't allow them to raise prices when we have historical inflation.
Excuse me.
Going crazy.
I don't want to get into politics side of it, Steve. Hang on a second.
Right. Oh, well, politics.
Remember in 2008 crisis, most of the homes were bought by big shops, from BlackRock to Blackstones and all. They just gobbled up every homes which were available. That's
Well,
what
let me bring in politics again. So let's talk about the ULA tax, right? So
Yeah,
in Los
talk
Angeles,
about
the
that.
ULA tax is just brutal, not only for me buying a $5, $10, $15 million home, but it's brutal for commercial real estate. So for those that don't know about the ULA tax, it was passed in November of 22. It places a 4% tax on all properties less than 5 million and 5.5% charge on properties over 10 million. It's destroying commercial real estate in certain areas, and it's also destroying, the large family homes that are trading products. So talk about that a little bit. I'm sure you're seeing it here in your California practice.
Yeah, I haven't personally seen it. I know there are attorneys like Jason Brooks in our Orange County Nashville offices. He deals with a lot of the ULA issues and has some creative possible ways to.
Well, let me hear those, because I know there are
so,
creative ways to make it work, putting certain properties in trust, right?
Different
Setting them up differently in LLCs. There is a workaround, but it's just brutal.
Yeah.
Right? It's really hard.
Yeah.
And then talk to me about that same tax that's hurting commercial real estate. How are you seeing that ULA tax affect commercial real estate prices? Or I want to sell a building to Marty wants to buy it. How is that affecting our relationship buy and sell?
Yeah, no, that's a great question, but the reality is that's not the primary issue. The primary issue is that interest rates have driven cap rates. That's fundamentally what's going on in the industry. Commercial real estate is a leveraged product. That's what allows us to create huge yields in that space. Well, the fact is the Federal Reserve went on a tear and in the fastest year-over-year pace ever increased rates to the point where we're in what's known as negative leverage, where effectively the cost of capital is higher than cap rates. So until that reverses itself, commercial real estate is going to remain relatively dead in the water, compounded by this issue of the ULA. So the negative leverage always resolves itself. It's been around this go round longer than it ever has in the history, at least of my short 32-year career. And it's going to resolve itself either by cap rates floating up, which they are doing as more distress hits the marketplace, and interest rates coming
But
down.
I've got to have the money. If I'm a family office, and that's who we're talking here today, is family offices, and those of you that, are watching remotely or might see this again over on YouTube. It's just, how do we help the family offices position for this? Should they keep their powder dry and stay on the sideline? Or, Rich, let me come to you. Or should family offices get in the game now and just sort of hang in there for the next 5 to 7 years of full market cycle? What are you doing internally, and what are you telling the groups that you advise? Because I know you have an advisory business to family offices.
I can tell you, most of us right now, is wait and see approach. We are deploying capital at a wait and see where, when we read about the $500 billion of losses have to come through, when we read about 50 banks are on death watch on the Federal Reserve System, that's not a promising stage to say, go deploy capital. And then you look at most of these coastal cities and states, the legislations they are passing, they are not making common sense. So why would you want to deploy capital in this kind of stretched environment where you just hold on to your capital? And that's what's happening more and more.
Okay,
What do you mean
so,
by coastal?
yeah, when you mean coastal, you're talking what? The Miamis, the Floridas, the Bocas, the Houstons, the Galveston.
Mostly New York City and mostly New York City, California, San Francisco, go into Miami as well. There's some issues.
Okay,
You can't get
take the opposite
insurance.
approach
How do you
back.
build a property in Miami?
Yep, so let me fight against that. So I'm gonna push back and take the other topic, because Stephen thinks that you should not be sitting on the sidelines. If you've got dry powder, Stephen's saying deploy. So tell me why you think that.
Well, I'm saying cautiously deployed. Look,
Uh-huh.
Deploy.
if you look at it historically, the typical cycle from top to bottom is about 5 years. Assuming the
That's a
top of
market
this
cycle.
market, right, was August of 2022, then we're 5 years before you hit the bottom. But along the way, there's going to be some extraordinary opportunities.
Right.
So am I all in today? Oh, no.
Yeah.
No, but selectively, we're starting to see some of those opportunities being acquired. In San Francisco, being one of your coastal cities that you're talking about in a relatively liberal state, has been devastated by not just the economy, the pandemic, but also from current policy in the local area.
Policies. Yeah.
And so when values are off 75% for multifamily and off 90% for office in a prime location in a gorgeous gateway city here in the US, maybe that's an opportunity we need to start thinking about taking advantage of.
So, okay, let me circle back. So, Brian, let me ask you a question about, again, let's go right to family office.
On top of that,
sure.
you see big companies like Blackstone investing heavily in multifamily right now.
But is that multifamily rent to own, or is
Right.
that multifamily
Build to
what?
rent and-
Build to rent?
Yeah,
Right.
Yeah, and it's single family
I mean,
rent to own.
yeah.
Yeah.
So I'm thinking, family offices underwriting criteria. You work with family offices, you counsel them. Are you helping them with that underwriting criteria to buy properties? Do you see that they even have an underwriting criteria? Are they organized? How are family offices actually coming to the table, thinking about how we're actually going to do this? So talk about their underwriting ability. Do they farm it out to a third party? Are they staffed properly? Do they come to you? Talk about that underwriting of the family office that might want to get into commercial real estate.
Yeah, it just kind of depends. They're farming it out to some firms like ours to handle. Depends on the structure. They may have their own internal people that are doing the underwriting as well. But yeah, we're handling a lot of those. Not me in particular, but others in my firm are handling.
So Rich, I know you've got a hard stop at 5 o'clock. So let me just ask you that same question, because I know, you're coming to the end of the time that you can spend with us. Talk about your underwriting ability. Talk about how you're staffed. But more importantly, are you also farming out that underwriting to a third party, an accounting firm, a real estate firm? You hiring sort of a gun to come in and take care of that for you? How are you staffed? How are you doing that?
We have very well-trained consultants who we go to. These are the folks who have done CMBS and RMBS structuring, technology side, as well as the folks who have done CBRE and other guys who have done tremendous amount of underwriting of all kind of asset classes. So we mostly do underwriting internally. If we have a doubt, then we may get a second opinion from another expert, which we have on the roster to call up. We have
What will you-
not,
what will
to
you
date,
pay for
we have
that?
not, huh?
What will you pay for that?
Well,
How much?
consultants charge us on a flat fee basis, on an hourly / fee on the outcome on the property if we buy it. So flat fee is few $100 per hour, but if we buy the property, they get a piece of action.
Wow, I like that
As a
structure.
real estate investor / equity investment.
Fabulous.
So
Rich,
we tag them along with us, and they
Yep.
make more money that way than paying maybe $500 or $1,000 an hour for their expertise.
brilliant. Thank you very much for your time. Thank you for joining us, and look forward to chatting with you soon.
Appreciate it, and I enjoyed chatting with you. Thank you very
Pleasure.
much. Bye-bye.
Absolutely. So let me circle back to you, Stephen. I want to talk a little bit about, I think, capital. I'm a family office. I'm sitting on full. I got a lot of dry powder, and I'm thinking about investing. And I know rates for equity are 12. I know if I'm going to do PACE, it's probably somewhere around 8 because you're probably 350, 400 over the 10-year treasury, which today is at 4.2. I'm thinking about putting out equity, senior equity as a family office. What kind of rates do you think I can command for 5-year money before a recap?
Are you talking about debt?
Yeah, talk debt.
Yeah.
Yeah, not equity.
No,
Definitely
so
debt.
it depends on who you are and what your banking relationship looks like, but it's gonna start with a minimum of an 8 handle, and it could go up to something north.
Oh,
of
I
10
think you're
handle.
light on the 8 hand.
Oh, yeah, it's a minimum. So there's those with strong relationships with national banks.
Yeah.
With financial center banks that have that relationship, right? But it's gonna start at a minimum and go up to the mid-12s. And that's just senior debt before you're talking about mezz or pref equity.
Yeah, which gets more expensive. So
Far
I'm
more
sitting
expensive.
on 5 projects. I cannot get senior. My clients just can't get the senior. It's too expensive. The caveats are too tough.
You're talking about construction?
Oh, absolutely.
Yeah.
They can't get construction money. And if they're, trying to refinance, they're just pushing it out and pushing it out. The rates are too high.
Yeah.
So I'm thinking, are family offices really a good place for somebody in the real estate building business who is building to go look for capital? That's really my question. Are family offices ready to kind of get into the game?
Not from a construction perspective, not at least in my opinion. Construction is a difficult game to play in today, unless you have a very, very specific niche like industrial, right? But multifamily is arguably overbuilt. We've seen more built in the last 3 years than we have since the mid-1970s. So as much as we talk about a lack of housing in the US today, we're seeing far too much product come online. We're seeing product that is half developed, half built, a lot of them in the Northwest, that's just, it stopped. It stalled construction.
I know.
So then, yeah, you know this, right? So the notion of going out and building something that competes with existing product is pretty much on the table. Moreover, we're seeing not just flat rents, we're seeing rents decline, particularly in the multifamily space. Some of this decline is precipitous. It's dramatic. Decline we haven't seen since 2008. So a combination between abundance of product, maybe overdeveloped product, and declining rents, or effectively declining fundamentals, means lenders are not particularly clean.
I'm not talking about lenders. I'm really just talking about the family office. I want to make sure that family office who's listening today has to make a decision. He's sitting on full, but he has to get into the game. And is this a way to do it? So Brian, let me come back to you.
Sure.
You're kind of a client's lawyer or a lawyer's lawyer. How do you advise clients to think about possibly deploying capital? What kind of a decision tree are you going through to say to clients, okay, asset allocation, real estate is here, distressed is here, loan is here, whatever you're going to do in real estate? How are you advising clients to possibly make that decision to be a funder of commercial real estate in today's market?
Yeah, I think it kind of goes back to what Steven said, be cautious, don't just jump at the first opportunity. You got to really dig into the details of these deals. And just make sure that you're deploying your capital in the right place. There's just a lot of different opportunities out there.
I just want to make a comment here. It seems like the cycle having been in the family office space for a long time is from being an equity investor to becoming once you're successful, becoming a debt lender, right? And so, where does that fit in terms of jumping in? Because I think debt is pretty dear right now.
Marty, that's a brilliant question, and we're starting to see some of the best and brightest, whether it's family office, private equity, hedge fund, step into the private credit space. Because those yields today are equivalent to the yields yesterday for equity.
Give me a number.
mid-12s,
Yeah.
mid-teens,
Yeah.
right?
Yeah.
And so when you can achieve yield on a senior secured basis without taking any equity risk, that's a good play. That's a good play. Now you got to be conscious about how it's done, right? And diligently underwrite your asset because look, every market is not created equal. Every product type in every market is not created equal. So would I be investing in retail pricing in
No.
Phoenix, Arizona? The answer is hell no.
I can stay the hell out of
No,
Arizona.
yeah, we look at typically overbuilt product like multifamily in Florida, Texas, Arizona, those markets have been.
So let me
devastated.
stop you. I've got
Please.
2 clients who want to put up 200 and 300, 400 unit apartments in the greater Miami area, stalled. They can't get senior. I have 2 hotels in Vegas. They already own midway through construction. They need more money. They cannot find senior. It's too expensive. So I'm seeing deal after deal break, or we just can't get them going on the next level. They just can't find senior. It's just too hard right now.
Sometimes our lenders are our governors. They tell us, meaning if they imply, the lack of capital implies that maybe it's not such a good bet. Despite your faith in the fundamentals of the real estate and that specific asset, if a lender says no, maybe that's just a good indication that's not the right investment today. And a lot of these broken developments are actually being acquired by groups like family offices and private equity, and they're acquired at a basis that is far lower than the current ownership has. So it reduces dramatically their all-in cost once built. So that's a different play.
Are there any, so I'll tell you something that happened after 2008 was a company came to us and they said, we're looking for, an investor who can give us a certain amount of equity so we can get a warehouse line, which the bank is coming up with. And so we introduced it to a very prominent Northwest Pacific family office, known for building Vancouver, used to live out in Palm Springs. Anyway.
And their zip code is.
Right, and we had a meeting in New York, and the guy said, you know what, how about if I lend you $15 million, can you make that look like equity? So, absolutely. So, and I need 35% returns, can you do that? Sure. So, one opportunity out there to produce debt that functions like equity. To structure, I mean, you're an attorney, how would you structure a deal where, having another level of financing
Yes.
can get you to that warehouse line that you're looking for?
Oh,
Not that I'm sure warehouse lines today will give you the kind of, rates you had in 2009.
yeah, I don't think I can speak to that. I don't handle a lot of financing work, so
Yeah,
that type of structure would be foreign to me, so I'm sorry.
It's doable.
Yeah.
It's absolutely doable. It's out there. It's doable. There are, I'll call you in 1 second. It's definitely doable. And you just have to be creative enough, but the family office has to be serious. And you can't be coming in, spending due diligence dollars, spending time. It's 6 months. He decides to walk away. I have 10 family offices I'm working with, and all they're doing is kicking tires. And it's costing people money, right? To come in, to do the due diligence, it's underwriting. We will request fees and say, look, we're gonna do this due diligence for you and do this financial engineering. You've got to come up, and make a decision. So we're seeing a lot of family offices, they're not performing. They're coming to the table. They want to be in the space. They just don't perform and they sit back on the sidelines. So we'll never call
they
them
don't have
again.
to.
That's true. Right. So you wanted to sort of talk a little bit.
To Marty's question, I mean, if you're the sponsor of a half-built hotel in Las Vegas, which is still a great growing market,
Huge.
of course, you'd rather give somebody some equity upside and get the project built as opposed to let it fail. So there must be solutions. The question is, who are the sources of debt capital? Probably not banks, because banks don't
Thanks,
care
Rob.
about equity upside.
Thanks,
It's
Rob.
probably pension funds, it's probably sovereign wealth funds. Could be.
How about family offices?
Could be family offices.
Well, what matters- what matters-
That's what the real estate markets are.
Right.
But what matters is the financing structure. I mean, the point of the work that we did with this guy out of Oregon and Vancouver was that he had a structure that he was looking for.
Right. It can be difficult.
And he got the deal.
I think kind of what you're talking to is the notion of rescue capital.
Yeah, absolutely.
Yeah, so rescue capital is big business these days, and it's going to become even more prominent as we further dive into this world of distressed commercial real estate. We're just, in my opinion, we're in inning 2, right? We have a long way to go before we really bounce off the bottom. People are already talking about a recovery. No way. That historically says that's just wrong. So rescue capital, fundamentally structured correctly.
Yeah.
Looks like debt at some level, but also
Absolutely.
performs like equity.
So let me take your up on that theory, and I'll start with you and go right over to you. So, Brian, tell me, what are the themes as we go into the second 6 months of this year? What are the themes as we go into, 25, the first 6 months? What themes are you seeing, forming for, obviously family offices, but for multifamily, which is an area you play? What are the themes for the next 6 months? Okay, we've got an election coming up, we have interest rate changes, et cetera. And then the next 6 months to June of next year. What's themes playing out that we should be aware of? Or family offices that are listening today be aware of?
The companies that I work with, the big multifamily operators, owner operators, are looking at more affordable housing. I know it's difficult to comply with regulatory wise, but there are opportunities there. Student housing.
Fabulous.
Both really good
Okay,
opportunities.
so when we talk, workforce, are we talking Section 8? Are we talking LIHTC credits? I mean, talk to me
All of
about
the
what,
above.
all the above. Okay,
Yeah.
so do you like LIHTC credits? Do you like the credits that come with, some of the, Section 8s or come with, affordability, housing?
Yeah, my clients seem to like it. So, I like it.
I think Section 8 is great. I have so many customers that are, moving to the Section 8 or already in it and have been in it for 10 years and they just didn't want anybody to know about it.
Sure.
I've got 4 properties that are being built right now, 200, 300, 400 units each, all in the greater downtown Los Angeles area, all around USC, all Section 8. And they're covered and they're going to do an amazing job. They've got their financing in place and it's modular.
Yeah.
So, let's ask a quick question. I'll turn it over to you. What are you seeing in modular? You seeing anything in modular in terms of just out there in the market? Guys talking about modular at all?
Well, I'm certainly no expert, but I tell you what, I've been
What do
waiting
you
for
hear?
modular to come around for the last 20 years.
Good.
It's just taken a long time.
You ever been to a factory for modular housing?
I was in a factory for modular 15 years ago, when Dwell magazine first started publicizing this
I was
notion.
just in a modular factory up in San Francisco. I was just at one down in Los Angeles. A friend of mine just went to one in Mexico City. They're cranking out 3 to 4 one-bedrooms every day. They go on a truck, as you know, they go on a flatbed, and they get rebuilt by, the GC. And the one I was up in San Francisco, they actually took over an old, what was it, battleship? No, I think it was submarines. They took over an old submarine base that already had the structure, so they just moved right in. It was actually from World War II. They sit right on the water and they had barges lined up. And we said, what are you doing with the barges? Oh, all of this is going to Hawaii. And it's to that village that got burned down. I forget the name. Lahaina, right? It's going there. So modular can work in the right position. But I just wanted to put on the table that modular is an amazing asset class and it's going to work.
From a cost perspective, from a time perspective, there's really nothing that can touch
Nothing.
that. Stick built on site is
Too long.
old school,
Correct.
but we've been working, Sears in their 1906 catalog came out with a modular house. More than 120 years
I've heard
later, that still is not a robust component of our industry, which it should be, right? For all the reasons you mentioned.
Right.
But it will. It's gonna take a change in attitude and new adaptation of mentality, but it will be a major part of the future.
So let me go back to you. So Brian, talk to me about, if your clients are there, if not, it's okay. Malls got mauled, right? So 2001, 2003, the malls just absolutely got mauled. I think they're easier to retrofit. They're easier to change. They're easier to sort of like come in with a new idea. Buildings like this would be too tough to make a change. Are you seeing any opportunities, anything that your family offices are thinking about? Because you represent Seattle and you represent San Diego, so basically the whole West Coast. Anybody going in the mall direction to maybe put some money into malls that are family offices?
Yeah, we've seen that here in San Diego. I think there's someone doing that up in the UTC area here in San Diego. I think it's a good opportunity. I mean, like you said, I think it lends itself more to retrofitting to, what the needs of multifamily are.
It does.
I think it's a great opportunity.
Well, let's go back to distressed debt for malls. Right, they're on the market, they're available, they're out there. I live in Los Angeles, right near me. Google just bought 3 or 4 malls. They were gonna put their entire staff in. They already did the work. They stopped the work. All the houses in the area for the first 6 months they were doing the work all went up by 10, 15% because they figured that the employees would need to live in the area and everybody was selling their house. They stopped work on it. And it was a mall, it was a movie theater. It just, it went several blocks. So are we seeing any opportunity or upside for malls?
Oh, it's huge. It's ginormous. The asset of a mall is not really the infrastructure, the improvements, it's the dirt. Malls, we tend to find, are extremely well located and have a lot of dirt to accommodate parking, right? So you've got great location, big piece of real estate that's been partialized, that's been assembled over a period of time, and now it's ripe. And the answer is not it's a reposition. You tear down the infrastructure, you tear down the buildings, and you build multifamily or whatever suits that demand in that marketplace. But yeah, if you look at the CMBS track record of the greatest losses on an individual loan, 90% of the time it comes associated with regional malls, right? I mean, those losses give you more than 100% of the outstanding debt. But if you're on the other side of the trade, you can make a fortune. But it all comes down to your underwriting, how well you negotiate, and what your
Exactly.
basis is, the acquisition.
We don't know, I don't think we have any time left, but I do have one more question. Do you guys have any thoughts on this insurance situation? Being able to insure multifamily? I mean, you know, this building collapsed in Miami Beach a couple of years ago.
Sure.
And since then, I'm being told that the average HOA is requesting in Florida that any building over 30 years old is gonna require $100,000 payment to HOA to make the building compliant
So
for insurance purposes.
yeah,
For retrofitting it, you know.
Retrofit protection.
And I don't know if that's happening in California or happening along the East Coast, because it's similar builders.
Look, this
Any
insurance
thoughts?
issue is a nationwide issue. Rates, particularly for multifamily, has in many cases more than doubled in less than a 24-month period, which is
Wow.
devastating to ownership.
Yeah.
Because that loss of revenue on a capitalized basis means a huge loss in terms of asset value. But it was kind of anticipated, right? With the fires and the floods and the increasing devastation associated with the storms that we're experiencing in this world today. It's kind of anticipated. In fact, it's from my opinion, it took longer to achieve these higher rates than anticipated. However, we see that there's potentially some light at the end of the tunnel as insurance companies tend to be highly profitable over time, right? So it's a matter of, did they swing the pendulum too dramatically? And are they gonna get a little bit closer to center? I think the answer could be very well yes, but that's all crystal ball stuff.
Right.
It has been effectively devastating us.
So Brian Atkins, I'm going to give you the last word. It's your office, your firm, you're our host today, so thank you very much. So, you know, from your perspective, again, I know you cover from Seattle down to, you know, LA. Talk a little bit about what you're hearing or just what you're seeing in demographic mobility. People saying, I've had enough with California taxes, I'm going to Vegas. I've had enough with California, you know, tax or doing business, and I'm moving to Texas or Florida. Are you seeing that among your family offices doing demographic mobility out of a high tax bracket state to a lower?
The family offices
Yes.
themselves? Oh, yeah, definitely seeing a little bit of that. But I mean, a lot of times they move and then they come back. Like California is just a great place to live, you know?
It's the 5th largest economy in the world.
Exactly.
That's
Yeah. And there's so many good opportunities here that you want to have around you. So, yeah, I mean, we see some of that, but it's kind of a mixed bag.
Yeah, I think we all saw that through that 2001, the mobility moving, you know,
Mhm.
from sort of the family offices that I know aware of from New York to Florida, and, you know, the real estate obviously just moved as a result of it. So Marty, thank you. IvyFON, thank you. We appreciate your time today. Thank you for inviting us. We love being here.
Absolutely, great job, guys, thanks so much.